Good morning, good afternoon. Thank you for attending today's session on the overview of valuation regulatory changes. Before I make some introductions, I'd like to cover a few brief housekeeping items. This webinar is being broadcast live. We suggest that you enlarge your media player to full screen when viewing the presentation. As you have questions, please use the Q&A widget on your screen to submit any questions. We'll try to answer them along the way or follow up after the session as possible. Today's session is being recorded and will be posted to the Due Diligence Insights page on our website in due course. Before I introduce myself and Pam, just a quick overview. Earlier this year, Duff & Phelps announced a plan to change its name to Kroll, the world's premier provider of services and digital products related to governance, risk, and transparency. Certain businesses, such as ours, are using Duff & Phelps, a Kroll business, for a transitional period. Duff & Phelps, Kroll, and our family of acquired brands each have a rich history. Unifying under the Kroll name allows us to represent the full suite of services we provide to our clients and a cohesive approach to delivering solutions to the market. For nearly 100 years, Duff & Phelps has helped clients make confident decisions in areas of valuation, real estate taxation, transfer pricing, disputes, M&A advisory, other corporate transactions. Kroll is the world's premier provider of services and digital products related to governance, risk, and transparency. We work with clients across the diverse sectors in the areas of valuation, expert services, investigation, cybersecurity, corporate finance, restructuring, legal business and business solutions, data analytics, and regulatory compliance. We have over 5,000 professionals located in 30 countries around the world. So let's get started. I'm David Larson, a managing director in the alternative assets advisory practice at Duff & Phelps, a Kroll business. I've been with Duff & Phelps now for about, going on 15 years. Prior to Duff & Phelps, I spent 22 years at KPMG. I focus in the alternative asset space on a number of regulatory matters in addition to serving clients. I sit as a member of the Standards Review Board of the International Valuation Standards Council. I was part of the IPPA, the International Private Equity and Venture Capital Valuations Board, and served on the AIPPA task force that recently issued or published a 600-page guide on private equity and venture capital valuation. I'm pleased to be joined today by Pam Bentley. Pam was formerly this Chief Accounting Officer of the Carlyle Group and now is the Chief Financial Officer for GCM Grosvenor. Pam, I'd probably have done you not done a good justice on your background. Why don't you give a little bit more about you and your firm, and then we'll kind of launch into our discussion.
Thanks, David. Thanks to everyone in the audience, those in the States who have joined very early, like David and I, who are actually on the West Coast today. So it's a little early here. And a privilege to speak to all of you this morning and this afternoon. I'm Pam Bentley, as David said. I joined GCM Grosvenor as Chief Financial Officer in October to help the firm go public, actually via a SPAC merger that we'll talk about later in November. And prior to that, as David mentioned, I was at the Carlyle Group for over 15 years, most recently as a Chief Accounting Officer, which included oversight of valuation, and had the privilege of working with David closely over my time period at Carlyle. He is definitely one of the foremost people in valuation and the right person to be here speaking with all of us today. Prior to that, I was at a small firm that I also took public and started my career at Arthur Andersen, where I was for almost 10 years before they closed and merged with all the other firms in 2001. Most notably, one of my best achievements is that I'm the incoming chair of the board at Junior Achievement of Greater Washington. I'm incredibly passionate about education in America and reforming education and making children work ready and entrepreneurial. And so I spend a lot of my free time working with junior achievement, and I'm absolutely passionate about that. But I'll turn it back to you, David, so we can get started to talk about the wonderful world of valuation regulations.
So thanks, Pam, and I'm very pleased that you're able to join me. We're really going to just, Pam and I are going to have a discussion and allow all of you to listen in. This today's program on focusing overall a number of sessions with respect to due diligence insights and fundamentally from a limited partner perspective, but also kind of highlighting what general partners should be doing in the world of alternative assets. And there's a number of different sessions, a number of different tracks, more than you can take in a given day. So that's why they're all going to be recorded and be available for the replay later. So this is our first session kicking off the valuation track, and we won't get too deep into valuation. There's some other sessions that will touch more specifically on things like SPACs and some of the nuances. We really want to keep this a little bit high level and talk about some of the things that are impacting kind of from a macro level the industry today. And as we think about things, and I kind of go back in time, and I sometimes put this up as a slide, I will sometimes ask groups, where did we start in a fair value world? Where did we start with kind of regulation in the alternative asset space? And I think you can go back to really the early 1900s when we first started, I'll say, with the Bessemer Trust, kind of some of the early private equity deals we saw in the 1970s, some of the first really big buyout deals. Then we kind of had a shutdown, for lack of a better word, of some of the big investments of the big buyouts in part because of tax law, which is something that will be interesting to see how that impacts us going forward now that the industry has significantly changed. From a valuation perspective, really the big, we started, it was the 1940 Act from the Investment Company Act that kind of gave a view of how we should be thought about in the alternative asset space. And when we start thinking about valuation, some have always thought, well, they kind of picked to 1989 where the National Venture Capital Association tried to come up with valuation standards and failed. But the guidelines that they came up with at the time became the de facto standard, which was to value things at the lower of cost or impaired value, which was interesting and probably maybe appropriate at the time, but they really kind of missed the boat slightly in that they said, use that premise, whereas the accounting standards required fair value, willing buyer, willing seller pricing. But accounting back then, and I'm an auditor in a former life, really told us to be conservative, and we thought conservatism was a good thing. But then you kind of roll forward to the internet bubble bursting, and at the turn of the century, around 2000, 2001, 2002, and that kind of premise of holding things at cost kind of stuck there, and not very many people, especially in the venture capital space, wrote things down. And that gave rise to PEG, or the Private Equity Industry Guidelines Group, and PEG coming up with valuation guidelines that basically were kind of earth-shaking at the time, that said, well, let's value things using generally accepted accounting principles. We have to value at fair value. That means that if the value goes down, yes, you write it down. If the value is flat, you keep it flat. But if the value goes up, you write it up. And that was kind of a new concept at that point in time. That gave rise to the IPPA guidelines. And then we've got the new accounting standards a couple of years after, in 2006, which were the old FASB 157, fair value measurements. We used that for a while. We then had convergence with international accounting standards in about 2011. We switched from calling it 157 to Topic 820 under U.S. GAAP. We have IFRS 13 under international standards. We also, around that time, 2008, 2009, had the financial crisis, and that gave rise to Dodd-Frank and gave us some significant new regulation in the world of alternative assets. We fast forward, the IPEP guidelines have been revised several times. We get to our current day and age. At the end of 2020, the SEC issued new, for the first time in 50 years, issued new guidance on determining fair value in good faith for mutual funds and the like. But that kind of regulation will flow over into some of the private funds. And we also got the guidance that we can start moving into, because of say, rules by the SEC or statements by the SEC and the U.S. Department of Labor, that we can start moving some of our private funds into retail investor portfolios, 401ks and the like, or target date funds. And so there's kind of a lot of movement as we kind of look over all of those things over the past 20 years, 40 years, 100 years, just to see kind of where we got to today. So Pam, as we kind of look at that, I mean, there's a lot of those pieces, a lot of them kind of are second hat to many of us. There's a whole bunch of things that we could talk about that maybe we'll wait to the end: ESG, crypto, climate, inflation, tax. I'll save those kinds of things to the end, but just kind of from a day-to-day and thinking about the SEC coming to visit, or in particular, as a limited partner, the kinds of questions that they should be asking or thinking about in the context of regulation. What's kind of your perspective in thinking about things from that, I'll say, very macro regulatory lens?
It's varied. We've been through quite a bit of change, as you mentioned, over the decades, and new regulations in the face of economic challenges, or revisiting existing regulations, and that's going to continue into the future. Certainly, I think that for LPs, the scrutiny on valuation regulation and valuation process and policy with their GPs is growing. Operational due diligence in general by LPs is continuing to be a focus area. Definitely, I feel like it always has been a focus area of the SEC, in particular the Division of Investment Management, when they come in and review us as GPs, that we're always prepared to review our valuation policies and processes. But I think firms have to continue to invest in providing more and more transparency and better documentation of how they're arriving at valuation conclusions. So I think the scrutiny and the SEC Rule 2A-5 that has recently been put forth to make sure the boards of registered funds have proper oversight of valuation policy and process and comfort with valuations is going to put even more scrutiny and focus on that from both the regulators and the LPs. So more regulation is likely to come in this area as people continue to focus on it.
So as we kind of think back in time, I'll ask about kind of your time at Carlyle, and I know Carlyle, which is, as we know, is a longstanding private fund, private manager, made the decision to go public. You're now at a firm that's making the decision to go public, maybe through a slightly different, rather than a regular IPO, but through the SPAC route. As you kind of look at that and kind of think about scrutiny and rigor and transparency, have you seen a need to, as the public lens has been placed on you, is that much different than the limited partner lens? And as I kind of think back over time, I remember at times again, I've been doing this for a long time, so if you go back again 10, 20 years, it felt like limited partners were maybe a little bit less in tune or rigorous about some certain things than they have become in the last 5 years. Is that just a natural evolution? Is that just the overall size? Or is it also the public lens with the SEC becoming more involved post Dodd-Frank and the like?
I think with the continued growth in the number of GPs, and the industry is just getting older, right? It's really only 3 decades old for the most part, excluding the hedge fund world, which has been around a lot longer, about 50. I think LPs are continuing to get more and more sophisticated in this area. And again, as we've had in the 2008, 2009 credit crisis and Dodd-Frank, I think LPs continue to focus on lessons learned from economic crisis and focusing on making sure they have a better understanding of the risks in their portfolio and their portfolio construction risk. And valuation goes a long way into understanding how the underlying portfolio is performing when you're dealing with long-term illiquid asset portfolios in the alts. And so I really think that from a GP perspective, regardless of Grosvenor, for example, going public, we always had had great rigor around our valuation policies and processes for the LPs and for the regulators of the funds. Primarily the SEC, when they come in and review to make sure that we're doing the right things by our investors. I think going public only adds to that, meaning there's even more scrutiny on top of the SEC and the LPs looking at our valuations. You also then have the PCAOB coming in. You have the management company auditors, the GPs auditors, paying more attention for the economic impact to the manager. And so you just have additional scrutiny on an already good process. But I wouldn't say that it's changed or would change, how a GP is or is thinking about their valuation policies and processes. They should be robust regardless of whether or not the manager is public.
I got it. And I want to kind of come back to that a little bit in a second, but let's touch on maybe a little bit on the valuation world. The AIPPA published in August of 2019, or July of August of 2019, kind of leading into the whole pandemic, not being able to anticipate that, a new 600-plus page guide on valuing alternative investments. As you kind of think about that guide, did it? And I'll ask a question and feel free to talk frankly. But do you think it was really necessary? Do you think it helped? Do you think it harmed? How did that kind of go? And as we kind of think about valuation, as I said, we had the PEG guidelines both way back in 2003, the IPEP guidelines in 2005, 157 came in 2006. So it's been 15 years, and yet the AIPPA came out with a new 600-page guide. Did we really get it that wrong over the past decade plus? Or what's the need for kind of having that much additional guidance be out there?
I'm going to turn this question back on you in a second, but I proudly still have in my office, and looking forward to getting back there, an autographed copy of the AIPPA Fair Value Guide from Mr. Larson himself, since he co-authored much of it. And I think that the guide is a practitioner's guide. I think it's incredibly helpful to provide some consistency, which is really putting a science to an art of valuation. Because it is such an art, because there's so many judgments inherently involved in setting values of our investments, having a practitioner's guide to ensure consistency of certain things. I'll pick on transaction costs and real estate deals, but having something that really helps the accounting firms and the GPs themselves really have something to look at to say, gee, I've got a complex situation here. How should I be thinking about this? And so I find the guide incredibly helpful just in terms of the number of examples. You can't capture everything, but, there's enough in there to really help, I think, the auditors also ensure consistency of their practices across the GPs. And so I think it was just a useful clarification tool to existing regulation. I didn't feel like it was, setting new regulation. But I'll turn that back to you because you were involved so intimately, and maybe you can talk about it a little bit from your perspective of the original impetus for the guide, and it took 2 or 3 years to get done, or maybe longer. You'll have to remind me how long that was.
So I think it took us 6 years to write the guide, and
oh wow!
And at the beginning, I think there were several groups, including the NVCA and others that actually pushed the AICPA not to write the guide, because they were kind of afraid how it may become too prescriptive. And if you think about it in the context of things like the IPEV guidelines are about 40 or 50 pages, including their kind of explanatory pieces and appendices. Why do we have to take 600 plus pages to write a guide? And one of the answers, and you touched on it, is that the IPEV guidelines don't have any examples, and that was done by the IPEV board by design, because the moment you have an example, you run the risk of having a template and say this is the way to do something. Well, with the AICPA guide, we kind of pushed the pendulum to the far other side, where we made it so rich with examples that you couldn't say, well, here's a template, because there's a number of different examples. There's half the guide is kind of a 20 or so case studies, taking investments through various measurement dates and thinking about how to value them, different types of investments, different situations, and the like. So I think that it was very helpful at that point in looking at it, in trying to kind of get down to the practical implications of Statement 157 of Topic 820 of IFRS 13. And I think that we sometimes lose sight, and even LPs sometimes lose sight, that of the importance of coming to a good fair value number. I remember at different times talking to LPs, and really sometimes the deal people on the LP side that said, hey, just keep things at cost. We don't really care, it doesn't matter. And then you probe a little bit and realize, well, it does matter that if you're a public pension plan, you actually show your results up on the screen in a open forum every month, and that you're making asset allocation decisions, you're making lots of decisions as an LP, follow-on fund, your own financial reporting. All of those different types of pieces you have to deal with as an LP. And if you held things at an arbitrary value such as cost, it really is not helpful. It's not helpful to your financial reporting, not helpful for your internal decision-making, not helpful for any of those things. And an LP has to, when they're valuing a fund interest, generally the primary way to do that is to make sure that all of the underlying investments are reported at fair value. And they have to do that to be able to get down to use that reported net asset value as their fair value estimate. So there's a whole multitude of reasons why it's important, and I think that the guide just kind of helps that. As I get fair value related questions today, I immediately go to the guide, I find an excerpt and basically pull it out kind of almost word for word and say, this is what the guide says. And I think it's been exceedingly helpful, as you said, both to auditors and to regulators, to at least say this is what the guide says. Now there's still moving pieces, there's still judgment, but I think it's been helpful in dealing with some of those difficult judgments. You mentioned, Pam, Rule 2A-5 of the SEC. mean, when the rule came out, it's actually accompanied by a very long document kind of explaining it. It's almost 200 pages. And the rule is kind of embedded for about 4 or 5 pages at the very end of that document. So you kind of have to read all the way to the end to find out what the actual plot is. But when you kind of think about 2A-5, has it changed the way you're starting to think about valuation governance?
No, only because I think it changed the way for some of our registered funds, and how the board of the registered funds maybe more closely reviews valuations, or how we talk to the board about any valuation challenges in any given reporting period. So I think it's, good because it's forcing the right conversation at the level of the registered funds boards. And then in general, again, just brings, more awareness to as you just mentioned, the importance of these marks, and on a quarterly basis, and that valuation is important, and that no cost is not the right answer necessarily. And so I think generally it is just put more of a framework on what boards should have already been doing, and more onus on board members to take responsibility for those marks. And so again, it's just increased the visibility and the conversation around valuation. And again, LPs should, I think, benefit from that scrutiny. So.
And as I think about 2A-5, and while it's really the registered fund space that it applies to, conceptually, there's no reason the concept shouldn't apply to the private funds and private fund managers. I mean, my takeaways are a board or the founders they're responsible for the fair value conclusions that are reported to investors. They can't outsource that responsibility. They can delegate certain functions. They can delegate to the advisor, to others. They can utilize to continue or to fulfill their testing requirements. They can use third parties to help validate the fair value estimates. So there's lots of things that they can do and should do, and I think it just kind of really codifies. In many ways, I think you're right. It tells us what others have been doing for the last few decades. Again, they changed rules that have been in place from 1969 and 1970, but it's really not that different for most modern funds in what they're doing. I want to switch gears a little bit and think about the last couple of decades. We had the internet bubble that burst in around 2001 or so. That gave rise to PEG and IPEV. We had the financial crisis, 2008, 2009. That gave rise to Dodd-Frank. We've now we're still not out of the woods from a pandemic perspective, but we've been involved in 2020 and significant economic impact and changing the way we do business. The reason we're doing this on webcams today, in part, is because of the pandemic. If it weren't for that, we'd probably be together sitting on a podium in New York or someplace doing this session. And yes, we may do that at some point in the future, but we'll see how things have changed. But with the pandemic, we had IPPA issued some special guidance with respect to valuation in March of 2020, but we haven't seen any kind of new regulation yet. Do crises really beget new legislation or new regulation? Should we expect post-pandemic to say, well, we need to relook at things, we need to regulate the alternative asset industry more? Or is it the things that have taken place in, let's say, stronger valuation policies, the regulatory framework that was created by Dodd-Frank, is that enough? Or should we expect that there's going to be something more now that we've had another crisis and supposedly that's impacted people adversely?
I'm not sure that the current pandemic is going to result in changes it certainly has resulted in more scrutiny on specific investment impacts from the pandemic and what those impacts are and how that has either increased or decreased an asset value. So it certainly has caused us to put more scrutiny on our valuations relative to the pandemic. I'm not sure that the pandemic will drive specific regulation here. Interested in your perspective on that too. I would say that we should expect more regulation, and I think what's going to drive that and more transparency, what's going to drive that is really the shift into more retail investor access to the alternative industry and alternative products. And the level of sophistication of valuation of illiquid positions in the alt industry and holding long-term investments and the level of risk associated with opening up this industry to more of a retail base is really probably what will drive more scrutiny and even more regulation in the future. And that's where I would expect more of the regulation to come from. And then in terms of, further economic shocks or crises, I think that existing regulations always have to be reviewed and renewed, in the best interest of the investors, and to make sure that they are, constantly, they're kind of living, breathing, modernized. So I expect that there'll be constant change and constant evolution here as things happen, unfortunately.
So I think I tend to agree. I don't think, as I think about, in just thinking about it from a pure private investment valuation perspective, I think we did a pretty good job during the last year. I think there was a huge shock to everybody in March of 2020. I think I remember hitting the 15th of March and still had, and even getting to April and still being hopeful that we could take a family vacation to Italy in July. And that was kind of very wishful thinking. But as it kind of, you look at the public market shock and then rolling that through, I think that in many ways it's kind of the nuances that you started to touch on, moving alternative assets into kind of the retail space, and the kind of lofty stock market public markets that are kind of impacting values. If anything that you kind of look through this crisis, you say, well, there's been some ups and downs. The magnitude or the continued increase in the public stock market is as much mind-boggling as anything, and the people that are much smarter than I can kind of explain that. In the private asset space, we have to kind of take that indications of value into account at some level, knowing that there's a good deal of loftiness there, that those are different kind of market participants and have to deal with them. But it is very interesting to see kind of how that will play. So I really think it's going to be kind of this intersection of how we take and think about private assets, how they become more publicly traded assets, that have different types of people that are investing in them. And one of the places that's maybe as much as anything is we see that is the SPAC market. We saw that if you look at, I think we just flipped the corner where we have more SPAC IPOs than traditional IPOs. We have substantial capital raised. We saw the SEC directly or indirectly through the warrant liability accounting issue basically shut down the SPAC market for a few weeks or a month in April. But should we think about this as SPACs? Do the SPACs need more regulation, or is that just a something that is out there that's good to really get more public companies out there, get us out there more quickly, allow more access to quality investments by retail investors? What's not to put you too much on the spot, but kind of where are you feeling from a SPAC perspective? Is that a good thing? Is it a place that we think we will see more regulation because of the exponential growth in that market?
Well, having just gone public through a SPAC merger, obviously we're the beneficiary of that, and it is, it is a somewhat quicker process. I wouldn't say it's much quicker. If anything, I would say, oddly, a SPAC IPO provides more transparency to investors as to both the growth prospects of a company that's going public, as well as the risks associated with the company going public. If anything, I'd say there's more transparency in a SPAC process than there is in a regular way IPO. And the reason for that is companies going public through a SPAC are sharing their projections and their models and their growth trajectory with all investors. They're not just sharing them with the underwriters and the book runners and the co-managers in an IPO. They're sharing them publicly. And so it's interesting to see, the SEC the SEC try and crack down on something that in a lot of ways provides more transparency to investors, which I always think is transparency is our friend. So I view, going public through a SPAC as not necessarily a bad thing. I think that the volume of transactions has been overwhelming, and it makes it difficult for the regulators to keep up. That I certainly understand. We certainly want to make sure that these things do have a lot of scrutiny from a regulatory perspective. Obviously the risk is that if the regulators don't, if the volume's too high and the regulators aren't spending the time on these that they need to, that's a problem. And so, there's going to be a fine balance to SPAC regulation, not allowing the capital markets to work efficiently, but not slowing down, and at the same time maybe making sure that the regulators have enough bandwidth to handle what they're looking at. And so that is a fine balance, and they're there to protect investors as well, and so that them having that time and the right scrutiny is important. We certainly want to avoid the internet bubble, right? The 99, 2000, and sometimes this a lot of SPAC IPOs are technology related, and so you certainly want to make sure that there's enough scrutiny, and asset prices do feel high, right? We do feel kind of in this bubble-esque environment, and we hope not, because honestly, there is a strong growth story behind a lot of these IPOs, and regulations are better now in terms of what's out there than what existed in 99 and 2000 to hopefully protect investors and make sure investors understand the risks that they're taking when they invest in these IPOs. So I'm a supporter, but I do think there's got to be the right balance of regulation.
So it's helpful. Let me turn just in a few minutes we've got remaining. You touched on the retail side. As I think about retail, moving alternative assets into retail, I got a couple different questions. One, if you think about putting a fund interest into someone's 401k, and many people, not all, but let's say that they look at the value of their 401k. In today's world, maybe they look daily, but maybe they look at least weekly or monthly. It's priced, the underlying investments are generally priced daily if they're in various mutual funds or publicly traded stocks. And so if you kind of look at it from that perspective, is the alternative asset industry in a position to report more timely and more frequently? By more timely, right now we generally are on a quarterly, or with frequency we're on a quarterly cadence. And we usually do that 45, 60, 90, 120 days after quarter end, depending on whether it's year end or an individual quarter. Can we do that more timely? And can we do that more frequently? And that's kind of one side of the equation. The other side of the question, the other side of the question is, will that impact positively or negatively the traditional investors in alternative assets? Let's say sovereign wealth funds, public pension plans, private pension plans, high net worth investors. that really weren't as focused or didn't have a need to be focused on kind of that daily pricing. They had a long-term view, whether that be 5, 10, 15, 20 years, even beyond the life of a fund. So we've got kind of these two things that are now coming at us, where timeliness, frequency, and is that going to impact either the availability of investments to the historic investors? Does that upset the entire apple cart for alternative investing?
I don't think it does. I think it's a growth opportunity for the industry. I think it is, I think providing retail investors access to the returns in this industry is a good thing. So do I think that it has significant challenges that you just mentioned? Yes. Portfolio construction and liquidity management in putting alts into registered funds and, potentially, regular mutual funds that have daily prices, when in a world where fair value is not determined daily, certainly poses challenges. And the timeliness of the availability of that information poses challenges. And so portfolio construction is important. We'll see growth, and liquidity management is important, and we're going to see growth in the rise of secondary transactions as a result of this. And so I think the secondary market will continue to grow in terms of secondary fund interest. The more we figure out how to properly put alt products into retail funds. So anyway, it still has its challenges, but I think is more good than bad in terms of the opportunity for the industry.
So with the few seconds we have left, maybe 30 seconds, if we're having this conversation again in 5 years, Pam, what do you think will be our key things that we'll be talking about?
Oh gosh, I don't have a crystal ball there. I wish I knew. But I think there's so much going on. Obviously now the focus on, in particular, ESG and climate risks, and infrastructure spending, re-stimulating all these economies. We certainly hope we don't see an economic crisis as we face, continued inflation risk, and interest rate risk and Fed policy. So I'm sure we're going to have a lot to talk about in 5 years relative to all these things, and whatever I haven't figured out, or whatever our crystal ball doesn't show us. But my guess is our plate will be full.
I agree, and I think whether we'll be talking about various type of cryptocurrencies, whether we'll each have our own digital wallet, where things will be, whether taxes will have helped or hurt the industry, be very interesting to see. Pam, I greatly appreciate your insights today. I appreciate you taking time to help us kick off today's session on the valuation track. Again, we encourage all of our participants to listen to the recordings of the sessions you can't listen to today. But there's several additional sessions that are listed throughout the day. Follow the platform to select those that are of interest to you, and listen to the recordings of those not. But again, thank you for participating. Thank you, Pam, for your time.
Thank you. Appreciate it. Have a great day, everybody.